Target, TGT on this one. I think we all know Target. I hope I don't need to explain this one. I mean, if you live certainly in the United States of America, I think you're well aware of Target, okay? Over the past 5 years, been a decent stock. It hasn't been an amazing stock, but it's been decent. But in regards to Target, pretty simple one. So Target used to be the most well-run retailer in all the United States of America, and they had that title for a while until Ulta took it away from them. But this company used to be a company that quarter in and quarter out, you knew they were going to come in with their numbers and they were going to probably beat EPS, and they're probably going to beat EPS nice. And if you look at this company over time, I mean, the EPS beats were just incredible. Target just knocking out of the ballpark. And then something happened. And in 2022, right, which says fiscal year 2023, but remember, this is like actual 2022 year, right? All of a sudden, the company started to report miss after miss after miss, quarter after quarter after quarter when it came to their EPS. And a lot of people started to distrust the stock on Wall Street, right? Because when you're known as the most well-run retailer and you're known as a company that comes in with beats every quarter, and then you come in with 3 consecutive big misses on EPS, everybody's like, what happened to you guys? What happened to you guys? Well, that's the past. Recently now, the company has started to come in with beat and beat and beat again and again and again as far as their EPS again. So the company clearly is getting back on the right track when it comes to their profitability, and that's a very, very exciting thing for me to see. I don't know if I could have, I don't think I could have really been a big buyer of Target stock last year, just given the fact that, you know, they were continually missing numbers, and it's hard to trust a management team that just misses numbers quarter in and quarter out. You got to kind of at least meet. But now, when I see this company beating and beating, and their stock price, you know, at, let's call it the lowest it's been in years, this is a pretty attractive time for me to be a buyer of the stock. I mean, to be honest, you have to go back to kind of around Rona time to find the stock trading this cheap in regards to Target overall, right? Now, in terms of the forward P, as far as this current year numbers, expected to be at about 16.6. Next year at about 14. I'll take that all day for a stock like Target. I believe, you know, the way I think about a stock like Target is, do I expect the stock to outperform or underperform the average stock in the S&P 500? I expect it to outperform when it comes to business metrics, right? And if I'm getting it for a cheaper valuation that S&P 500 trades at on average, then we're really, really talking, okay? Now, in regards to Target, the expectations for next year are on the floor. This is another beautiful thing. Analysts only have them on average growing 1% revenue next year. So, I mean, that's a pretty doomsday scenario considering the company's coming off of a bad 2023 for revenue side. So, imagine the company just grows 3%, 5%. You know, that's a pretty exciting situation when you're expected to grow 1%, right? And then what does that mean for EPS beats? Now, in terms of while I wait for the stock, I get to collect about a 3.5% dividend yield and payout ratio of a little over 50% on this one. So Target's one of these stocks, again, I feel comfortable buying the stock in any sort of situation. A crash, great economy, okay economy. Give me Target shares for $120 something. I'll take them off your hands, okay? Anything under $150 really for me is a buy. Obviously, the closer we are to 100, the more aggressive, I guess you can say, I'll be a buyer of Target stock overall, okay? We're going to talk about good old Tesla, my Tesla. So when it comes to Tesla, yeah, the stock obviously got hit Friday very hard. It was down over 5%. We're down over 20K on that one. We're down to our last $368,000 in gains on good old Tesla, so 938% on this one. When it comes to Tesla, here's what's going on. They just cut price. I'm so sick of talking about Tesla price cuts. It seems like every freaking week I got to talk about Elon just cut prices again, okay? So they dropped Model X to $80,000, a $41,000 reduction. Okay, we're switching. Hello. A $41,000 reduction from the start of this year. What? Okay, so now the S and the X are going to be eligible for these tax credits. That's cool. That's good. But man, is this absolutely crazy, right? So check this out. Since the start of the year, the Model S started the year about 105. It's down to 75 now. The Model X started the year at 120. It's down to starting at 80. I mean, this is epic price cuts. I mean, if they cut $4,000, okay, they cut $4,000. Put me to sleep, okay? On a $100,000 vehicle, that's nothing. It's like 4%, right? $41,000 since the beginning of the year? Yeah, that's Elon on a mission, okay? Elon's on a mission to absolutely decimate, it seems like everybody else, and he just wants to move volume. He's like, I don't care. I will cut price. I'll do whatever I have to. I am about moving units. That's all he cares about. He doesn't care about margins right now. He doesn't care about profitability. If it's not clear already, I don't know what's going to make it more clear. And I've been talking about this for pretty much this entire year. Elon does not care about margins right now. He does not care about profitability at all. At all. Not even like 1%. Like maybe a little. No. Okay. All he cares about is volume. That's it. And so that creates us into a dilemma in the short term where margins are probably just going to keep going down. Because I can guarantee you they haven't saved $41,000 in cost on these vehicles. They might, find ways to save a few $100 here, a few $1,000 there, but it's not 41,000. This is coming straight off margin. This is coming straight off profitability. Okay? And so ultimately, it's a great time if you're an S or an X in the market for that. But the problem is, if you're really down the Tesla rabbit hole, you see Elon keep cutting price, and Tesla in general. Right? I don't want to put it all on Elon, but you see them keep cutting price, and at the same time, you're like, why wouldn't I just wait? Seriously, like why go buy an S or X unless you absolutely have to tomorrow? And that's the problem if you keep cutting price, because let's say you were bought after the first cut, you're like, oh yes, I got 95K, woo, okay, now it's 75K. So who's to say? In another month, 3 months, whatever, it's not going to be 69K, right? 69,420. That would be an Elon move there to make on the S, right? Who's to say the Model X isn't going to 69? So these are the sorts of things you gotta run through these scenarios with Elon, and he's just on a mission to move as many units as he can possibly move, and he doesn't care at all about margins of profitability. If he had to take Tesla into net loss, he would take it in net loss. It's clear. It's clear. He doesn't care at all right now about profitability. So it is what it is. As a long Tesla shareholder, this is stuff you have to kind of go through. But it's not too fun in the short term. I can tell you that it's not too fun in the short term. But the long term remains intact. And you don't want to compete with Tesla, man. They're nasty to compete with. They're beating you on tech. They're beating you on the vehicles. And they're beating you on the price. You lost. Like Tesla won. But it's just not going to look like it in the short-term profitability numbers, I can tell you that, okay? Revolve, RVLV. This one might be a little more of a hidden stock for folks that some people might not know of or be aware of. But in regards to Revolve, they are a very successful e-commerce company in the fashion industry, clothing space. And specifically for millennials, like younger folks in general are huge. That's not their whole customer base, but under 40 is a huge component of their customer base overall. And they own Revolve and they own Forward. Forward caters much more to the very high end, which is a space that's been hit recently. If you look at some of the Louis Vuitton numbers, if you look at even like the Estee Lauder numbers, which is the highest end makeup company in the world, those numbers have not been too exciting recently. And the same thing's kind of going on with Forward business here recently. Now, why is the stock being killed so bad? Okay, why is the stock gone from $80 to $14, right? The numbers, so net sales, obviously, the company was blasting off net sales, and then now recently net sales have fallen 6%. Gross margins have fallen about, let's call it 200 basis points roughly year over year. Net income fell 55%. The company is still profitable, but much less profitable than they were. Certainly a couple years ago when they blasted from $14 million of net income to $31 million of net income, right? To now be back down to 7 is just a huge disappointment. Adjusted EBITDA fell 61%. So all the numbers in the short term are pretty much bad. The only good number I can pretty much see is active customers up about 14% year over year. Total orders placed is, slightly growing, but considering your active customers has grown 14%, that total orders placed is not an impressive number whatsoever, folks, okay? Now, if we look deeper in the business, the net sales, bad for Revolve, down 4% year over year. Forward, down 15% year over year. Revolve, as far as gross profit, down 7%. Forward, down 23%. The numbers are bad, just bad across the board, okay? And so that's how you get a stock price to go from 80-something dollars to $14 here today, folks. That's how it happens. Now, with that being said, I do not believe the reality of what is going on currently is going to be the long-term reality for Forward or for Revolve overall. Revolve has a phenomenal balance sheet, first and foremost, on this company, which I think the balance sheet gives you a good insight to how good a management team really is, okay? And in terms of Revolve, they built this balance sheet up tremendously over the years, $269 million of cash and cash equivalents now, as far as the latest quarter went. $629 million total assets. That's versus total liabilities at $223 million. That's over $400 million in total stockholder equity. Very impressive. And if we think about this company over time, it has been an incredible growth company. I mean, these two gentlemen, the two co-CEOs of the company, right, have grown this company from a nothing company just 10 years ago to what it is today, right? The company even in 2017 did $400 million in revenue. This past year, they did $1.1 billion of revenue. I like a management team that not only has a proven business over time and is just going through tough times in the short term, but these gentlemen, I'm going to give them the benefit of the doubt. These guys have done tremendous over time. They've built this business up. I'm going to give them the benefit of the doubt. Not all management teams deserve benefit of the doubt. But for this management team and what they've been able to build over time, I'm going to give them the benefit of the doubt in this situation. And I believe brighter days are in Revolve's future in 2024 and beyond. But it's been a really rough patch here in the short term for the company. And I believe they'll turn things around in 2024. I believe profitability will come around. I believe margins will come around. And I think it'll be up and up from there. But nonetheless, folks, it's always a risk. And it's a risk I'm willing to take in regards to Revolve.